All right, let's talk about supermicrocomputer or SMCI. You've probably heard the name. They've been one of the absolute hottest stocks in the whole AI revolution, making the essential gear that powers everything. But their latest report? Well, it has the market taking a step back and asking a big question. Is the incredible AI boom about to hit a reality check? Let's dive into the numbers and see what's really going on. But first, you know the drill, a quick disclaimer. This explainer is just for informational purposes. It's not financial advice, so please always do your own research before making any investment decisions. You know, for months, the entire narrative around AI has been just unstoppable growth. And SMCI has been riding that wave big time. But the latest earnings have thrown a wrench in the works, and now everyone's wondering, is the company's profitability starting to feel the strain from all this crazy fast expansion? Let's see what the data actually said. Okay, so let's get right into the headline numbers from their latest report. This is kind of the snapshot of how they're doing right now. And honestly, it's a bit of a mixed bag. First step, revenue. The company pulled in $5.75 billion. Now, on the one hand, that's up about 7% from last year. So, they're still growing. But on the other hand, it was just a little bit short of what Wall Street was expecting. It's a solid number, for sure, but not quite the home run that some people were banking on. And it's pretty much the same story when you look at how much profit they made. Earnings per share, or EPS, came in at 39 cents. That's basically their slice of the profit pie for each share of stock. And just like with revenue, this number also landed just a little below what the analysts were predicting. So the top line and the bottom line both were just a tad off the mark. And that brings us right to the main event, what analysts are really pointing to as the big issue. It's this idea of a margin squeeze. This is where the story gets really, really interesting. So take a look at this. Gross margin is basically the profit a company makes on every single thing it sells before you factor in other costs. Last year, it was at 10.1%. This quarter, it dropped to 9.5%. Now, that might not sound like a huge drop, but it's a really important signal that they're making a little less money on every dollar of sales. And that's a trend investors watch like a hawk. And here's the kicker. This wasn't just a one-off bad quarter. The company's own management came out and said they expect this margin pressure to stick around into the next quarter. So what they're telling us is that this tough environment, well, it might be the new normal for a little while. Okay, but that's all the short-term stuff. To really get why there's so much excitement around SMCI, you have to zoom out and look at their absolutely massive potential in the bigger AI power play. This really lays out the whole conflict for the company. On the one hand, their strengths are huge. They're a leader in the AI server market, and they're experts in what's called direct liquid cooling, or DLC, which is the super advanced tech you need to stop these powerful AI chips from literally melting. But on the flip side, all that success attracts more competition, which leads to pricing pressure. And boom, we're right back to that margin squeeze we were just talking about. And this is the number that makes everyone sit up and pay attention. Even with all the short-term issues, the company is forecasting revenue of around $32.8 billion for their 2025-26 fiscal year. I mean, that is a gigantic number, and it's the single biggest reason for optimism. It's a huge bet that their role in building out the world's AI infrastructure is really just getting started. So, what are you supposed to do with all this? You've got this short-term pain from squeezed margins, but then this massive long-term growth story. It's a real puzzle. Well, let's look at how one analyst is breaking it all down into an actual game plan. The strategy here is pretty simple, really. It's a two-part approach. First, if you already own the stock, the thinking is to hold on through this dip because you believe in that long-term AI story. But if you're looking to get in, the advice is to be patient. Wait for this short-term pressure to maybe push the price down even more into a target range somewhere between 31 and 35 bucks. So based on all the fundamentals, what do they think the stock is actually worth today? This particular analyst pegs the fair value target at $59 a share. And just to be clear, that's not a price prediction for tomorrow. It's more of an estimate of its underlying value based on all the financial data and that big future outlook. Which leaves us with the ultimate question, doesn't it?
You have this company that is an absolute giant in the most critical part of the AI industry, with a massive runway for growth. But at the exact same time, it's facing very real, very measurable pressure on its profits right now. The big unknown is, will that future AI dominance be strong enough to win out over the current margin squeeze?
And that's our look at super microcomputer. Hey, if you found this explainer useful, do us a huge favor and hit that like button and subscribe. It's really the best way to support what we do and make sure we can bring you more of these. Thanks for joining us.